Have you ever wondered how the world's wealthiest investors protect their fortunes from market volatility, economic downturns, and even financial crises? What if I told you there's a tried and tested investment strategy that can help you build long-term wealth while minimizing risk? Stay tuned as we uncover the secrets of Ray Dalio's all-weather portfolio and how you can build a balanced investment strategy that even the greatest investors would admire. Hey there, welcome back to my channel, where I'm trying to guide you to achieving wealth and financial independence. If you're new here, this channel is all about investing, wealth creation, and helping you make informed financial decisions. Today, we're diving deep into Ray Dalio's all-weather portfolio, a powerful investment strategy designed to weather any economic storm. So grab a notepad, and let's get started. Who is Ray Dalio? Before we jump into the all-weather portfolio, let's take a moment to talk about the man behind it, Ray Dalio. As the founder of Bridgewater Associates, one of the world's largest hedge funds, Dalio has amassed a fortune of over $20 billion. With decades of experience in the financial world, he's considered one of our time's most influential investors and thought leaders. Dalio's investment philosophy focuses on risk management, diversification, and understanding the economic machine. The all-weather portfolio. Ray Dalio created the all-weather portfolio in the 1970s as a way to protect his investments from unpredictable market conditions. The idea behind this strategy is simple. By diversifying your investments across different asset classes, you can minimize risk and maximize returns in any economic environment. The all-weather portfolio consists of the following asset allocation: 30% stocks, 40% long-term bonds, 15% intermediate-term bonds, 7.5% gold, and 7.5% commodities. The goal of this allocation is to create a balanced and resilient portfolio that performs well under various economic conditions, including inflation, deflation, economic growth, and recession. Understanding asset classes. To build your own all-weather portfolio, it's essential to understand the different asset classes involved and their roles in your investment strategy. Here's a quick breakdown. Stocks represent ownership in companies, providing potential for capital appreciation and dividend income. Stocks generally perform well during periods of economic growth. Long-term bonds, bonds with longer maturities, typically over 10 years. These provide regular interest income and tend to perform well during periods of declining interest rates and deflation. Intermediate-term bonds, bonds with maturities between 3 to 10 years. They offer a balance of interest income and lower volatility compared to long-term bonds. Gold, a traditional safe haven asset that helps protect your portfolio against inflation and currency devaluation. Commodities, physical goods such as oil, metals, and agricultural products. These assets provide diversification and can benefit from global economic growth and inflation. Building your all-weather portfolio. Now that we understand the components, let's dive into how you can build your very own all-weather portfolio. Follow these steps. Step 1. Determine your investment budget. Decide how much money you're willing to invest in your all-weather portfolio. Remember, this strategy is designed for long-term wealth accumulation, so only invest funds you don't need for immediate expenses. Step 2. Allocate assets. Using the percentages outlined earlier, allocate your funds across the 5 asset classes. For example, if you have $10,000 to invest, you would allocate $3,000 to stocks, $4,000 to long-term bonds, $1,500 to intermediate-term bonds, $750 to gold, and $750 to commodities. Step 3. Choose investments within each asset class. Within each asset class, select specific investments that meet your criteria for risk, fees, and performance. For stocks, choose low-cost index funds or ETFs that track the overall market. For bonds, consider government or high-quality corporate bonds. For gold and commodities, you can invest in physical assets, ETFs, or even mining stocks. Step 4. Rebalance regularly. Over time, your portfolio's allocation will drift as some assets outperform others. To maintain the optimal balance, you'll need to rebalance periodically, typically once or twice a year. This involves selling assets that have outperformed and buying those that have underperformed to return to your target allocation. Step 5. Monitor and adjust. As with any investment strategy, it's important to keep an eye on your all-weather portfolio's performance and adjust as needed. Be prepared to make changes to your allocations or investment selections as economic conditions evolve and your personal financial goals shift. Pros and cons of the all-weather portfolio. Now that we've covered the basics of building your all-weather portfolio, let's explore some of its advantages and disadvantages. Let's start with the pros. Diversification. By spreading your investments across multiple asset classes, you reduce the risk associated with any single investment or market sector. Resilience. The all-weather portfolio is designed to perform well in various economic conditions, reducing the impact of market downturns and financial crises. Simplicity. The asset allocation is straightforward, making it easy to understand and implement for investors of all experience levels. Now, let's take a look at the cons. Lower potential returns. Due to its focus on risk management, the all-weather portfolio may generate lower returns than more aggressive investment strategies during periods of strong market performance. Requires active management. Regular rebalancing and monitoring are necessary to maintain the portfolio's target allocations and adapt to changing economic conditions. Not tailored to individual goals, the all-weather portfolio provides a general framework for long-term wealth accumulation but may not be ideally suited to specific financial goals or risk tolerance levels. Conclusion. Ray Dalio's all-weather portfolio offers a robust investment strategy for those seeking long-term wealth accumulation and financial stability. By diversifying across asset classes and adapting to various economic conditions, this approach helps minimize risk while maximizing potential returns. As with any investment strategy, it's essential to consider your individual goals, risk tolerance, and time horizon when implementing the all-weather portfolio. With careful planning and disciplined execution, you too can build a balanced investment strategy that stands the test of time. There you have it. Now you know the secrets of Ray Dalio's all-weather portfolio and how to build your own balanced investment strategy. If you found this video helpful, please give it a thumbs up, share it with your friends, and subscribe to the channel for more content to guide you on your journey to wealth and financial independence. And remember, the road to financial freedom starts with just one step, so take action today, and start building the future you deserve. Until next time, happy investing!